Hello, everyone. Welcome to the Fuqua LinkedIn Live. I'm Campbell Harvey, Professor of Finance at Duke University. And today we're going to talk about the election. You're probably electioned out in terms of all the pundits talking about the implications. I think that in a way, everybody's got like an agenda. So let me put my kind of personal biases on the table. I did not vote in the US election because I can't vote. So I'm a Canadian citizen, not a US citizen. And this is actually interesting for me because I basically have skin in the game indirectly. I'm a guest in the US, but it allows me to basically comment on political events, not really being like a member of any US political party. So that's kind of where I come from. And I study business cycles, as you know from previous LinkedIn, my research on inverted yield curves and economic activity. And I also focus on investment. So in terms of my teaching, traditionally I've taught an advanced investment course. Many of you took this course. And part of that course is to kind of figure out the appropriate trade-offs between risk and return. And indeed, what is risk? So what we've seen usually, an election happens and there is a winner and a loser. And there's a resolution of uncertainty. So even if there's a 90% chance that somebody's going to win, and then they do win, there is a resolution of uncertainty that's important. So in our particular situation, we don't have a winner right now. But the US election is not a simple election like a parliamentary election in the UK or Canada, where if you win a majority of seats, then you are, the prime minister is elected from the party. Obviously, the US is a more complex system where you've got a House, a Senate, and the executive branch. So what do we know, given that this election at the presidential level is not settled? And what are the implications for the economy and financial markets? So let's kind of start with what we know. The first thing is something that we should have known for a long time, and that is that the polling is not accurate. So I thought we learned this lesson in 2016. I got an email yesterday morning from an old friend who reminded me of a conversation just before the US election in 2016, where it looked like Hillary Clinton was going to walk away with the presidency. And he reminded me of what I said. And what I talked about was the so-called Bradley effect. I said, don't believe the polls because of the Bradley effect. And what that means in our particular situation in 2016 was that given the, some of the behaviors of President Trump, many people were uncomfortable saying that they support him. And this definitely came into play in 2016. So in conversations with people, or if you're on the phone with the pollster, you'll say you're voting Democrat. But when you get to the actual polling booth or mail your ballot in, it's a different story. And the Bradley effect played out very powerfully in 2016. And I believe it played out in 2020 also. So the gap is a striking gap between the latest polls just before the election, which essentially gave Biden a double-digit lead, and what actually happened. So while polls are not that useful, in my opinion, there are other mechanisms that I think are superior. So the prediction markets, very effective. So much more effective than the polling. And we could see that play last night. For example, if you look at PredictIt, so all one word, .org, is probably the most developed prediction market. And they were saying that Trump was going to carry Florida. And that's exactly what happened. And various other predictions suggest that they're much closer. So where are we right now? So if you look at predictit.org, you'll see that Joe Biden has an 80% probability of becoming a president. So that's basically the way it works. There's high probability, in my opinion, that even though this election is not going to be resolved officially for a number of days, that we'll see a change in the presidency. So what does that mean in terms of the markets? Well, it turns out that the key thing for kind of the economic and financial implications was not the presidency, but the Senate. So this idea of having one party, whether it's Republican or Democrat, having the House, the Senate, and the executive branch, that potentially introduces risk. So one party gets their way. It is clear that this is not going to happen this time around. So it looks like the Senate will be maintained by the Republicans, and it looks like the executive branch will go to the Democrats, but in a way it doesn't matter because the House will remain a Democrat. So essentially, we've got a split system, which means that there can't be these bold actions that if one party has got control of all three, that they could actually pull off. So I'm making kind of a subtle argument here in terms of the resolution of uncertainty. And this has to do with if there is some division within the House, the Senate, or executive branch, then it just makes it more difficult to do something that might be viewed as more extreme. Okay, and again, this is not a political statement whatsoever. I'm purely talking about uncertainty. So uncertainty is not a good thing. Uncertainty causes, it's a type of risk. And when you're faced with this type of risk, often the optimal situation for managers, corporate leaders, is to wait. So if there's a lot of uncertainty, you delay that hiring. You delay that capital investment, that project that you want to build. And that tends to slow economic activity. So it is a good thing to resolve the uncertainty. And an important part of that uncertainty effectively has been resolved. So it is extremely unlikely that we will see a situation where one party controls all three. Okay, so that has been resolved. Now let's talk about the sort of financial implications and the economic implications. So I've got a few graphs that I would like to share and maybe talk through that. And I'm going to share not in presentation mode, but just so you can see this. And hopefully you can see this. economic implications of the US election. And let me just show you a few slides. And this is a key slide. So this is the US 10-year Treasury yield. And the action that we've seen after the election is in multiple dimensions, but I think this is the most important dimension, that yield dropped very substantially once it was clear that, that the Republicans were going to retain control of the Senate. It's also the case that the stock market has gone up. So indeed, it's kind of interesting to look at the stock market. That looks like the V-shaped recovery that I've talked about previously. I think it's probably far too optimistic, but nevertheless, this is where we are. And the stock market is up sharply today. So the question is why? And I believe there are two reasons. So the number one reason I've already talked about, that there is a resolution of uncertainty, even though it seems maybe a little counterintuitive because we don't know who the president will be. But that is actually only part of the uncertainty. So the resolution of uncertainty I'm talking about is the fact that one party will not control all three parts of the government. Okay, so that's one factor. The more important factor is the basic difference between the Democratic platform and the Republican platform. So the difference is that the Democrats wanted to be far more aggressive on spending, fiscal spending. The Republicans, while there's been considerable spending in terms of triage for the economy during the COVID-19 crisis, it is clear right now that the Republicans are hesitant to continue with the degree of fiscal support for the economy. That is the key difference. And why would the yield go down? Okay, so basically what we've seen over the last number of months is that inflation expectations have been going up. And we've seen the yields go up with those inflation expectations. And why would the inflation expectations be going up? Well, they're going up because of the following mechanism. That people in the market see the sort of fiscal plans for spending, and when they see that, they figure that's going to have to be paid for some way. And one way to actually do that is through inflation. It's also the case that the Democrats were much more aggressive on taxation, so increased taxation. So there's some benefit in terms of the stock market for that also. So I think that it's fairly clear that that at this point, where you've got the Senate actually being controlled by Republicans, that it will be extremely unlikely that some of that fiscal policy can be pushed through. And as a result, this, I think, tempers the inflation expectations and leads to the yields to actually decrease. Okay, so there's a third aspect that is even less obvious, and that is, it's somewhat related to my first point. But when you've got a split government, the government just isn't able to do a lot. There's a lot of negotiation, but often it goes nowhere. And given the election cycle in the US is every 2 years for the House, it's really difficult to take that long-term perspective. And indeed, I think that markets sometimes reward that. It's better to do nothing than to do something that might be damaging. And I do think that markets are somewhat concerned about the growth rate of the US economy going forward. We've seen growth continually decrease. We've seen innovation, where the US is kind of the leader in innovation traditionally. Well, we're seeing a lot of action elsewhere in the world. And you can look to China, you can look to parts of Europe also. The US might be losing that edge. And when you lose that edge, you lose your growth. Okay, so there's a lot of stuff actually going on here. What has happened to the markets is not really surprising to me. There's one thing that maybe is a little bit surprising to me, and that is a topic that I've talked to you before about, and that's what's happened to the price of gold. So the price of gold is actually decreased. So I'm not, that usually it goes the other way with rates especially. But again, I think that what a lot of people are doing is liquidating gold and buying equities. So at this point, I wanted to make only brief remarks, and my remarks have been somewhat longer than I intended. But what I'd like to do is to go to the questions, and I'm going to stop the share of the stock market. And I will go to the questions that we're getting. And let me just expand. Okay. Let's see. I've got Dylan, who's a current student. With the current split, lower probability of a tax hike, smaller stimulus. What's your take on the path of the defense budget, given the split, and specifically what this implies to defense equities? So my opinion on this is that we'll see more of the same in terms of the defense budget. So this is not something that's going to be derailed with whatever actually happens. So I don't see a particular investment play in public defense equities. So that's a pretty specialized question, and those that know me know that I'm more than willing to admit that there's certain, well, not certain, a lot of stuff I don't know, and I don't follow that particular sector closely. I do follow the sort of government support for various sectors, and I'm certainly not in a position just overall to make any investment recommendations. So what I'm suggesting is that the course of the support for defense is unlikely to be altered. Okay, so Brian, an alumnus, great to see you, virtually at least. How should investors balance the resolution of uncertainty and an increase in confidence in credit of US Treasuries, and meaning increase in willingness to buy lower yield with the potential for reduced demand for debt if equities are thriving? So this is a super interesting question. Thanks, Brian, for asking that. So, I showed you that chart of the S&P, and it effectively completely discounts what's happened with the COVID-19. It's like it didn't happen. It's over. It's a blip. And that's just not the case. So we got the GDP print last week. Oh, it was very exciting. And the way that it was described, obviously, was politicized. 33%. We've never had growth like that before. It's record growth. Well, it is record growth, but what didn't get any play was that to get back to where we were in the fourth quarter of 2019, that GDP print needed to be 53%, 53%. So that's way off. It's not even close. And remember, these are annualized numbers. So we're still far below where we were in 2019. Indeed, some of the media, I'm not sure why they're comparing to the first quarter of 2020. They should be comparing to the last quarter of 2019 because the COVID was in effect in the first quarter. So we need another print of approximately 10%. And I think that that's unlikely to say the least. So again, you've got this situation where markets are basically ignoring this. People are piling into the stocks that are already very expensive, the growth stocks. And a lot of this is retail demand. Speculators, it's kind of like a risk-on situation where you want to load up on the risk, thinking that there's good times ahead, and let's just ignore the pandemic, the second wave, the third wave, the fourth wave. I do believe we'll have a vaccine, and that will mitigate the damage in terms of human lives lost, but there is structural damage to the economy. You don't hear about it. You hear about some bankruptcies of high-profile firms that you knew were going to go bankrupt anyways. But what you don't hear about are the millions of businesses, the small and medium-sized businesses that are struggling, and many of them going under without the media attention. So I do think we're in a situation where the expected returns, given the price levels, are actually very low for equity. So prices go up, expected returns go down. And then you think of the fixed income market. And even if the 10-year yield is 0.9%, that's well below what inflation is. So you're actually paying. So you buy that bond, it's like an insurance policy. You're paying a premium for it because it's a so-called safe asset. But the risk is asymmetric. So there's only so far that yield can go negative. But if we have inflation return, then anybody holding a longer term bond is going to get hammered. So good question on this. I could talk all day on this because it's not just a US question. And I actually had another graph I was going to show in terms of central bank holdings and how they've just exploded. So the Fed balance sheet has gone from essentially, measured in the billions in 2007 to over $7 trillion today. So again, people are worried about one particular party using fiscal policy to create inflation. Well, I'm not sure we're out of the woods because the monetary policy is also has the potential to be inflationary. Okay, so I've got Sijen, who's got a question. Tax increase will increase inflation expectations. I was wondering if there is an intermediate step in between. Well, yeah, there's many intermediate steps. And this is like the real problem with macroeconomics, that so many of these variables are so-called endogenous, that everything's linked together. So there's these factors that increase or decrease kind of like both sides of the equation. And it makes it really difficult to figure this out. So we will eventually have to pay down all of the fiscal debt that's been racked up. And as I mentioned, there's one way to do that is to inflate. Another way to do that is to tax. Increasing taxes is pretty toxic. Nobody wants to vote for that in the Senate or the House, because if you do, that is the #1 item that's used against you by the opposition. So we've got a very dysfunctional system in terms of taxation right now. So it's much easier to inflate. So I want to be clear here that even though the markets are suggesting that the risk of inflation going forward is a lot less, given that we've got the Republicans controlling the Senate, I'm actually personally not convinced of that. I've got a different view. So inflation can be generated on the fiscal side or the monetary side. So I've got a question from Adam, who's an alum. What sectors can we expect to see an increase, decrease, given these results? So again, it's an awkward question for me because I cannot give out investment advice. Okay, so don't interpret anything I say as investment advice. So I'm not a financial advisor. I'm very careful in my classes also to say that I'm not giving investment advice in any manner. So I guess the question I could answer kind of more generally, that it's always the case that there'll be some industries that are winners and some industries that are losers. So certain industries that there was a target painted on, if there was going to be a sweep of the House, the Senate, and the executive branch, that target has disappeared. It's not going to be effective. So I think we know the type of industries that we're talking about, and all of a sudden they have become less risky. There is a sense that this election will be good for the tech industry. And we've certainly seen today the tech stocks jump in value, but that I think is fleeting. I don't know what the economic story is there. Indeed, the regulators are finally figuring out that we've got monopoly or duopoly kind of situation with many of these tech giants. And I consider that that presents a very large amount of risk. So I've got a question from, let's see, a question from Syed, and okay, just disappeared the question. And, oh, there it is at the top. Do you expect any changes in the tax rates for individuals and corporations? So I definitely expected a significant change in tax rates if the Democrats swept the House, the Senate, and the executive branch. And you just needed to look at the Biden tax plan, which definitely had increases in taxes. So I think that given that the Senate is controlled by Republicans, it'll be very difficult to increase the taxes. Do I think the taxes will increase over the next 4 years? I think yes, but it'll be subtle and it won't be as large. So there is some tax risk there. And Mary Beth, oh, great to see you, asked, what if anything could trigger signs of inflation, cause the Fed to consider rate increases? So there's so many things that could trigger signs of inflation. People are simply extrapolating from a simple one observation that during the global financial crisis, we had lots of QE, but we didn't have inflation. So then people extrapolate that and say, well, now we've got unlimited QE, so we're not going to have inflation. So I think that's really a very dangerous way to think. We can see the inflation expectations in the break-evens between the US Treasury, nominal treasuries, and the TIPS. And we can measure those inflation expectations. Those expectations have gone up, as I said recently, and now have moderated, but it's about 1.5%. Inflation's not very volatile. Over the last 15 years or so, the volatility of inflation is about 1%. So one standard deviation is 1%. So, but are there things that you would kind of be worried about? And yeah, definitely. And that those things are, the size of the balance sheet, the amount of QE. The QE is just another term for modern monetary theory. Okay, so think about that. So we're just like creating money. So the idea, of course, is there's no inflation because that money is parked at the Fed in terms of excess reserves. But if things change and those reserves go out, this is something that definitely could cause inflation. And of course, the fiscal side, if there's excessive spending, that's going to be financed, and it's often financed with inflation.